If you think the silver market is normal right now, this should unsettle you, not because a candle went red, not because the headlines got noisier, because a ridiculous amount of real metal just changed hands. Quickly, quietly, and mainstream finance barely reacted. In the first 3 delivery days of the new January contract, nearly 18 million ounces of silver showed up for delivery. Do me a quick one before we go deeper. Subscribe and turn on the notification bell so you don't miss the next update when the data shifts fast. You'll want the signal, not the noise. Let that land. 18 million ounces in 3 days. Now focus on the question we're supposed to ask, but nobody wants to say out loud. Who has the reach to source that kind of weight, move it, settle it, and still stay invisible? Because a 500-ounce mint box weighs around 40-plus pounds. Do the math on the pallets. Do the math on the trucks. This wasn't retail excitement. This was institutional hunger. And if you think it's a one-off spike, it's not. It's been happening month after month with billions of dollars worth of metal standing for delivery. The system keeps telling you silver is a side metal, but the system's behavior is screaming something else. We're not here to worship price targets. We're here to follow the metal. And right now, the metal is telling us the paper story is getting thinner. Quick disclaimer before we go deeper. This is educational. We manage risk. Now here's the trap most people fall into. They hear silver to $200 and they picture a meme frenzy. They picture a bubble. They picture a rocket emoji chart. But the uncomfortable part is this. You don't need hype for triple-digit silver. You can get there with boring arithmetic. If gold is sitting around the low to mid 4,000s and the gold to silver ratio simply drifts back toward its long-run average, the implied silver price is already in the neighborhood of $100. Not maybe someday, not if aliens land, just ratio compression. And that's before you account for the detail people skip because it's awkward. Silver comes out of the ground at something like single digit to 1 versus gold, while paper pricing has spent years acting like silver is 50 to 1. That gap is a stretched rubber band. Rubber bands don't stay stretched forever. They snap back. The only question is whether you're positioned before the snap or you're watching from the sidewalk when it happens. There's another layer we can't ignore, the market's memory. For decades, silver has been building a massive base, the kind technicians describe as a long cup with a smaller handle right before breakout. You don't need to be a chart wizard to understand why that matters. A multi-decade base is a dam. It holds pressure. The longer it holds, the more violent the release when it finally cracks. And if you measure that structure the way chart traders do, top to bottom, then project upward, you land in the same neighborhood as the ratio math. Triple-digit territory, 2 different maps, same destination. Now here's the part they bury under noise. The ratio has already been sliding. Not long ago, it hovered around the mid-80s. More recently, it's been living in the 50s. That's not a random wiggle. That's capital shifting its weight. And when ratios move, they rarely stop at fair. They overshoot. They do it with violence. That's when headlines scream unexpected. But it's only unexpected if you refuse to watch the ratio. And I want you to notice something about timing. These mechanical forces, rebalance selling, rule-based flows, portfolio resets, often paint ugly tape early in the year. Then, if the physical side is tight, the market looks very different a few weeks later. Not because the story changed, because the forced sellers finished selling. So when you feel the urge to react to a January punch in the face, ask the calmer question, is this a breakdown? Or is this the market shaking the tree before the harvest? Also keep your eyes on the two-way market fantasy. In a healthy market, sellers appear when price rises. But if the crowd already sold years ago, and the remaining holders are stubborn, then price rises don't summon enough supply. That's when the market stops behaving like an auction and starts behaving like a ration line. If we're wrong, where will it show first? Not in a headline. In delivery stress easing, premiums collapsing, and real bars becoming easy to source again. Until then, we assume the opposite. Tight metal, nervous paper, and a ratio still compressing against gravity. So what actually happened this week? A huge wave of deliverable metal moved. And at the same time, structural forces are lining up for January to be chaotic on purpose. There's a seasonal effect in January where new money gets deployed, portfolios get reset, and positioning gets rebuilt. But there's also something colder than seasonality. Some funds have rules. Indexes rebalance. When certain commodity indexes rebalance after a big move, they are required to sell some exposure. Not because they want to, because the rulebook forces it. And forced selling is the favorite meal of deep pockets. If you can predict the selling, you can stand there with a bucket and catch the metal when it hits the floor. That's why January can look like a mess on the surface and still be accumulation underneath. Volatility isn't a verdict. Volatility is a weapon. And if you don't know who's holding the weapon, you end up being the target. Now let's talk about the part that should bother every serious person watching metals. We're seeing signs that the institutions closest to the plumbing prefer holding the metal, not holding promises. That's the tell. That's the shift. Normally, big banks and global players pass metal back and forth like chips at a casino. Everybody smiles, everybody hedges, everybody pretends the paper is as good as the thing. But recently, large amounts of metal have been forced or motivated to move from one major institution to a few others. And those recipients didn't just take paper claims. They took delivery, they wanted the bars, and the stated reasons are vague. One says house account, another says client. Okay, but who is the client that wants that much metal? Who has that kind of balance sheet and that kind of urgency, and why now? Here's where we separate fact from interpretation, so we stay honest. Fact, large deliveries of gold and silver have been standing for delivery in size repeatedly. Fact, physical metal is changing hands and not in small quantities. Interpretation. This looks like a quiet preference shift away from paper confidence and toward physical control. And when the players inside the machine stop trusting each other's IOUs, the machine doesn't immediately explode. It grinds, it squeaks, it gets jumpy. Then one day, it reprices violently and pretends it was always obvious. Now, before we go any further, pause and look at the psychology they try to install in your head. They want you obsessed with the daily candle. They want you sick from watching 5-minute charts. They want you so exhausted, you'll dump your position just to get peace. Because if you sell, someone else buys. And who do you think that someone is? It's not your neighbor. It's the entities that understand scarcity. And scarcity is where this story gets dark. Most silver does not come from dedicated silver mines. Only a small slice of supply is primary. The rest is byproduct, pulled out while mining copper, zinc, lead. That means silver supply doesn't respond cleanly to silver price. It's not like flipping a switch. If copper production slows, silver supply can tighten even if silver demand rises. Do you see the fragility? Silver isn't a faucet. It's a leak from other pipes. And those pipes are aging. The easy deposits? Mostly gone. Silver is often found closer to the surface in certain deposit types, which means the big, simple, high-grade, skin-deep finds are rarer than they used to be. So the market leans on byproduct, and byproduct makes supply stubborn. Now add the next layer, industrial necessity. This is where people still underestimate silver, and it's almost funny. Not because it's humorous, because it's reckless. Silver isn't just jewelry and coins. Silver is circuitry. Silver is high conductivity contacts. Silver is the stuff you need when you want advanced civilization to keep working. AI hardware, robotics, defense electronics, high-tech manufacturing. When industries need something, they don't bargain like hobbyists, they secure. And we have signs that buyers are increasingly trying to secure supply upstream, not just buying refined bars, buying the concentrate, buying the door material before it's even refined, buying the metal in the ground. That's disintermediation. That's bypassing the exchange. That's stepping around the pricing mechanism and saying, I don't care what your screen says, I care that I can get it. If you're a viewer trying to understand what that means, here's a simple metric. Refining capacity is a choke point. If one country dominates refining, then that country can turn global supply into conditional supply. And we're hearing that refined silver exports are being restricted so that only state-approved refiners can ship out. The window gets narrower, permits get harder, small refiners get cut out. And if that refining hub handles a majority share of the world's silver processing, that policy shift ripples everywhere. So the question becomes, if the flow out slows and Western vaults keep seeing big delivery demands, where does the replacement metal come from? Now we're at the no fluff part, because this is where the price chart becomes less important than the inventory math. If metal goes into a vault and doesn't come back out, that's not liquidity. That's a sinkhole. And sinkholes don't announce themselves with sirens. They just keep swallowing until the street collapses. So, could silver hit $200? Yes, it's possible. Will it? We don't get to demand it. We have to watch the conditions that would make it rational. Here's a sane framework. If the gold to silver ratio compresses to around 42 to 1, you're already talking about roughly $100 silver if gold stays elevated. If the ratio overshoots because markets overshoot, then prices above $150 or even $200 become imaginable. Not guaranteed. Imagined. Possible. The point is, the path doesn't require fantasy. It requires the ratio to stop pretending silver is abundant. Now, what do we do with this? First, we stop playing the ego game. We don't marry a target. We marry the process. We watch the ratio. We watch delivery data. We watch refining policy. We watch whether big players keep choosing physical. And we accept that this ride will be volatile. If you came here for calm, Silver isn't calm. Silver is a spring. Hold it down long enough, and when it releases, it doesn't drift upward politely. It jumps. Then it whips. That whip is what shakes people out right before the real move. Now there's another mistake most people make. They assume if price rises, supply will flood in. That's a gold assumption. Gold is recycled heavily because it's concentrated and valuable per ounce. Silver is different. Silver is scattered. It's smeared into electronics and contacts and tiny pieces that don't get recovered at high rates unless economics force it. So the idea that higher price instantly creates a tidal wave of recycled silver is optimistic. Possible over time, not instant. Meanwhile, we're seeing a weird behavioral signal. Not many people are selling. That matters because in past cycles, when metals popped, you'd see a wave of cash for metal advertising and a flood of weak hands cashing out. This time the selling pressure looks thinner. Maybe the weak hand already dumped years ago. Maybe the public simply doesn't hold that much silver anymore. Either way, if fewer holders exist, then the release valve is smaller, which means when demand spikes, price does more of the adjusting. Now let's talk about the small investor versus big investor reality, because this is where we can be smart without being dramatic. If you're allocating 5 or 10 grand, silver offers leverage. You get more ounces, more optionality. If you're allocating 10 million, you start caring about storage, shipping, and friction. Gold becomes the music stops asset. It's dense, it's efficient, it's the final settlement metal. So for us, the play can be phase-based. As the ratio compresses, silver can outperform. When the ratio gets tight, think around 40 or below, history suggests rotating more toward gold. Not because silver becomes bad, because gold becomes the safer endgame. That's not ideology, that's mechanics. And if you're wondering why the market feels like it's waking up late, here's another clue. People inside the supply chain are acting differently. Mining conferences are seeing new faces, not just investors, industrial buyers, manufacturers, the kind of people who don't show up to trade. They show up to lock in supply. That's the signal this isn't just a chart story, it's a procurement story. And procurement stories end the same way. Whoever secures supply early survives. Whoever waits gets squeezed. Now watch this contradiction because it's where most people get fooled. The paper price can slam down even while physical demand is tightening. Those two can coexist. Paper trades expectations. Physical trades necessity. So if you see a smash, the first instinct is fear. But the smarter move is to ask, did physical premiums fall too? Did inventories refill? Did delivery data relax? Or did the screen drop while the real market stayed tight? That's how you tell whether the move is truth or trap. Now I'm going to ask you 2 questions, and I want your take because our community gets sharper when we compare notes. If institutions are taking more physical delivery, what do you think they're preparing for? Higher prices or delivery risk? And if refined silver exports tighten at the refining choke point, where do you think the West gets its replacement flow? Higher mining or higher prices, forcing demand destruction? Put your take below. Now we also need to talk about the quiet accumulation angle that scares me most. When big money starts buying upstream, concentrate, pre-refining material, even reserves, price becomes less relevant. These are price-insensitive buyers. They don't care if silver is $28 or $30, they care if they can get it at all. That's a different animal. That's the difference between a shopper and a survivalist. And when survivalists enter the aisle, the shelves go empty fast. So what's the likely near-term setup? More volatility, more forced flows due to index rules and seasonal reshuffling, and a tug of war between paper games and physical gravity. If you panic sell the volatility, you become the liquidity. If you understand it, you can treat dips as information events, not emotional events, but we have to be honest. None of this is easy. Silver will try to throw you off like a bull. It will spike, crash, fake out, and rip again. That's why we don't stare at the ticker like it's a slot machine. We measure, we zoom out, we focus on the plumbing, because the plumbing is where the truth leaks. And right now, the truth is leaking in ounces, millions of them. We'll keep watching the delivery numbers. We'll keep watching the ratio. We'll keep watching the refining choke points. So if you want the next update the moment the signal shifts, subscribe and turn on notifications, because you don't want to learn the rules after the doors lock. So as the next delivery report hits, ask yourself, where is the metal going and why is it not coming back? Let me know what you think in the comments below.